Shopify, the company that aims to make commerce better for everyone, released earnings earlier this week, and at first it looked like the market loved it, with shares going up to almost $140 per share. But then almost immediately when the market opened, it dropped, and from the height of that post-earnings jump until just a couple days later, the stock dropped 23%, which might leave people wondering, what the heck happened to this stock? Well, my name is Brian Stoffel, and we'll spend the next couple of minutes trying to figure out what indeed did happen to that stock. Now, I want to give a shout out to Fiscal AI for sponsoring today's video. You're going to see a whole bunch more from them in just a minute. So this was Shopify's fourth quarter 2025, somewhere in the ballpark of a $145 billion company. Now, on the top line, revenue grew 31%. Now, not only did that beat analyst estimates, but management said it would be mid to high 20% growth. So 31% growth blew way past that. Now, earnings per share did roughly double from the same time last year. However, they did miss analyst estimates. Management guided for about 18% free cash flow margins. They actually came in at 19.5%, so that was good news. Now, when we look at gross margins, they headed in the wrong direction. There is an explanation for why, and we'll get to that in a minute. That being said, both operating and net margins expanded slightly. Free cash flow grew slightly. Net income grew much faster. And this company has a pristine balance sheet with about $6 billion in cash, no debt. And it's worth noting that management authorized a $2 billion share repurchase program. Don't get too excited. That's only going to eliminate between 1 and 1.5% of shares outstanding if it was all executed at once. But to understand the dynamics of what's happening, let's look at the income statement right here. So you can see that revenue grew 31%. That's great. The problem is that the cost of that revenue grew 36%. How did that happen? Well, remember, there's two different parts to the business model with Shopify. The first part are subscription solutions. This is basically if you every shop that you set up, you pay a subscription to be able to use Shopify's their ecosystem. And there, it's good news. Those margins actually expanded from just below 80% to just above 80%. It's this other area, merchant solutions, where things fell. Now, merchant solutions is mostly Shopify Pay, but it can be other things as well. And what we saw is that dropped from a 38.2% gross margin all the way down to 36.8%. That's meaningful contraction. They did say that the main reason for that is that before they have lapped a full year, it's the last quarter where the integration of the PayPal partnership still plays a role. And by adding the ability to pay with PayPal, that did increase payments. So it was a trade-off that they were willing to do. Now, all of those different factors combined to make it so that gross profit, even though revenue grew 31%, gross profit only grew 25%. And also, just so you know, that same dynamic is probably what's going to continue to happen. Even if merchant solutions, even if those gross margins stabilize, the overall pie will probably still keep seeing its gross profit grow slower than its revenue because merchant solution is usage-based. It's the one that's growing faster, and that's totally normal and acceptable, especially when operating expenses are only growing at 20% versus 31% revenue growth. That's great news. In fact, it was such great news that the company, even though gross margins contracted, operating income grew faster than revenue, which is great news. Now, there were some other things that came up during the company's conference call, like, for instance, it is working with Google to have the Universal Product Protocol where AI agents will be able to search websites and be able to find the things that they're looking for and be able to do that easier because Google and Shopify work together to come up with a way to create that. Also, it's worth noting that Shopify is now an arrangement with different LLMs where if a merchant makes a sale with agentic shopping through Shopify, Shopify can actually take a slightly larger cut of that. Now, why would merchants be willing to do that? Because if I type in, hey, give me the 5 best coffee roasters I could find, I am almost 10 times more likely to buy one of those than if I was just searching the web and found it. So merchants are willing to trade some of their margin for more volume, which is great for really everyone involved. But to dive into more of the details of what's going on with the company, we're going to head on over to Fiscal AI. Now, this is a site that I use every day, and you have tons of functionality using it for free. You can click the top link in the show notes below to be able to do that. And if you decide for full functionality, you'll get 15% off of your subscription by using that link. So the first thing I want to show is this right here shows the growth of subscription solutions. So this is what people pay no matter how many sales they do. There's different tiers of it. And what I want to show you here is that ever since the end of 2021, subscription solutions has been growing at about a 22% clip. That's the green. The blue right here is gross profit from that. Now, as you can see, this is a very high margin product. And what's important is that's actually grown even faster at 23%. So those margins continue to expand. If we look at the other one, which is merchant solutions, and you can see here that merchant solutions has way more sales than subscription solutions, but that makes sense because it's usage based and it has lower margins, which makes sense because of what they're offering. The point is that merchant solutions has been growing at almost 30% over the last 4 years. Gross margins have actually been contracting over time. We want to see that stabilize. However, as they bring in new lower margin things that merchants can choose to use, that might just be part of playing that ball game. So it's not the end of the world. A couple other things that I want to show you on here using Fiscal AI. The first is gross merchandise volume at the company. Now what this measures is what is the total value of stuff that merchants sell using Shopify. And this is really expanded. I mean, if you look during the holiday quarter of 2021, merchants sold about $54 billion worth of stuff. Just 4 years later, it is more than doubled to $124 billion worth of stuff. And not only that, but the blue here, the growth rate has been accelerating. So merchants have been more successful and Shopify has been more successful right alongside them. But it's not just gross merchandise volume. We can also track gross payment volume. Why does that matter? Because as more people use Shopify Pay, as more merchants do, not only does that increase Shopify's revenue, it deepens the moat and widens the moat that's surrounding the company because it becomes integrated with the merchants. And again, look at, if you go back to holiday 2021, $28 billion traded hands with Shopify Pay. If you go to holiday of 2025, $83 billion. I mean, we're talking about more than 3xing. And again, that growth rate has been accelerating. This is really, really impressive. The last thing I just want to show is the overall take rate. And for this, I actually want to zoom out to the annual so you can see the trends here. What the take rate means is, of all the money changing hands in general, how much does Shopify get to keep? And you see that once they really started hitting their expansion phase, starting right here in 2016, ever since then, it has accelerated. They used to keep about 2.5% of every dollar that was trading hands, and now they're up to 3.1. Now that might seem small, but those little differences make a huge difference in the long run. Here's the other thing when it comes to Shopify that is so important. Brian Brody and I did a webinar earlier this week where we talked about what SaaS companies are going to not only survive but thrive in the agentic AI era. And we came up with 4 different lenses to view this through. So let's run Shopify through it real quick. The first lens that we offered up was the liability lens, which basically means is what you're offering. If what you're offering does it right 95% of the time, is that okay? If it is okay that it's wrong 5% of the time, then you might get displaced by AI. But if it's not okay, then you're probably not going to get displaced by AI. Now, when we talk about this, when it comes to Shopify, I would put it in that middle category. It would definitely be a pain in the butt for a merchant if they started screwing up some inventory and orders. It's not the same as, say, a government agency or Axon's evidence might send someone to prison or something like that. You might disagree with me, which is fine. I'm just offering you 4 different ways to view this. So I'd say robust for the first one. The second is the business model lens. Because look, if AI agents can do the job that if one human can do the job of what used to be done by 10 humans because they're super powered with AI, then if you're selling software that is seat-based, you're in trouble. However, if you sell it that is usage-based, well, then that's looking pretty good. And as I just showed you, Merchant Solutions is largely usage-based. So that's great news for Shopify. Third, software companies that have products that touch the physical world are going to be in good shape. If they don't have products that touch the world, then that can be a liability for them. Now, Shopify does have point of sale physical products that merchants can use. Now, I wouldn't say that's the most anti-fragile situation. Point of sale devices are at least they seem like a dime a dozen. That being said, there is some integration between atoms and bits here, so I would give it a robust rating. And finally is the network lens, where if you have a company where there's proprietary context, that's not only going to keep people in your system, but if you've got something that nobody else can get unless they enter your ecosystem, that will bring people in too. And all of the tools that Shopify is building for merchants to succeed in the AI agentic world, that does have a network effect. So I would argue that Shopify is set up to do fairly well in the AI agentic era. Now, when it turns to guidance, there was a lot to like here. I mean, management guided for low 30% growth in the next quarter, whereas Wall Street was way below that estimate. One problem was that the company did say that its free cash flow margins were going to be lower than a lot of analysts were expecting. Now, the main reason for that is because they're investing in many of the same things I've been talking about, like the Universal Product Protocol and in their AI agentic piping to make sure that they can dominate and their merchants can do well in this new paradigm. What should shareholders watch moving forward? Well, I think first, keep an eye on GMV growth. You want to see if they're capturing an outsized portion of the market through GMV growth in the AI agentic era. They said that the number of transactions happening with AI agents was up 15x from the same time last year. Now, that's off of an incredibly small base, but you want to see that trend continue. Second, keep an eye on guidance, because I wouldn't be surprised as we go along, if things go well, to see them inch up guidance as we go along. Third, keep an eye on free cash flow. While we know those margins will be constrained while the company invests for the future, we want to make sure that they're at least profitable. And fourth, just any commentary on AI shopping, agentic shopping, and what it might be doing to the business. Overall, I think that the moat is definitely stable, if not widening around the company, and is on track. Now, you might be wondering, is Shopify in my own portfolio? Well, I've been tracking my own portfolio since December 2014. These are the results from then until the beginning of this month. And you can see my results in the green are ahead of both the NASDAQ Composite in the yellow and the S&P 500 in the red. And I mention that because I have a program meant to teach people how I did this. It's called Stock Investing Mentor. And here's how it works. Every week we have 1 hour of live training sessions that are all recorded, where I'm trying to teach one nugget that can help you become a better investor. Whenever I make a move in my portfolio, you have access to my portfolio. And so you will get to see everything I own, and every time I make a change, you will get a video explaining that change. And third, you get 24/7 access to a private online investing community. If that interests you, and you want to find out what I think of Shopify, then click the second link in the show notes below, and you can get 10% off an annual subscription to Stock Investing Mentor that will expire on Sunday at 11:59 p.m. Now, let's move on to valuation, because with Shopify, that's the big question here, right? There's a bunch of different ways that we can try and value Shopify. Let's look at a couple of them. The first would just be simply looking at it based on valuation multiples. So we could look at, for instance, the company's forward price to sales multiple, their forward PE ratio, their forward price to free cash flow ratio. So let's just take a look at that, and we can see what we notice here. And what I notice is that if we look again on Fiscal AI here at the forward price to sales ratio, what I see is that it's currently trading at about 10 times sales, and over the last 10 years, that's about a 20% discount to where it's been. So it might look slightly undervalued at this point, although 10 times sales is expensive for a normal company. We could look at the forward PE ratio. Right now, Shopify is trading at about 61 times forward priced earnings. As you can see, it's been all over the place in the last 10 years. Technically, the median is about 105, so you could say that's undervalued, although that doesn't have a ton of value. And the last thing we can do is we can look at the forward price to free cash flow ratio. Currently, it's trading at about 55 times forward free cash flow. If we look over the last, say, 3 years, we can see that the average has been for the company to trade for about 72 times forward free cash flow. I mean, there's not huge conclusions we can draw from this, but technically cheaper than it has been in the past. I like to look at it using a reverse discounted cash flow analysis. Now, if I were looking at Shopify, I would look at it and say, I believe, and I think that this is neither conservative nor overly aggressive, I believe that they could accomplish roughly 22% free cash flow margins in the future. If they accomplish those 22% free cash flow margins off of this base of $11.6 billion, that would give them free cash flow of roughly $2.54 billion. So if we head on over here, we type in Shopify and we say $2.54 billion, we give Shopify a 3% terminal growth rate, a 10% discount rate. We need these prices to match each other. And so let's see. This will tell us how fast does Shopify's revenue need to grow per year over the next 10 years to justify today's stock price. And you can see that using these numbers, as recently as a couple months ago, when I personally sold my shares of Shopify, it was much higher. It had to grow at roughly about 28% roughly per year. But now we've come down, and we've come down significantly. Now we're at, let's see, about 21%. So Shopify needs to grow its revenue by about 21% per year over the next 10 years to justify today's stock price. Well, what is it expected to do? It's expected to grow 26%, followed by 23%, followed by 28%. And so 21% actually looks not too bad. You can also just go in and look at estimates and say, well, have analysts been right about this in the past? And the fact of the matter is they haven't. If you look at 2025, they started saying they'll get $10 billion in sales. Ended with 11.6, what we just saw. When they talk about this current year, they started out saying $13 billion in sales. Now we're up to close to $15 billion. So I actually think that this is a relatively attractive price. Does that mean I'll add shares? How much might I add? Well, that you can find out if you join Stock Investing Mentor in the second link below. Let me know what you thought of the company's earnings in the comments section, and don't forget to hit subscribe to find out how Shopify is doing when they report next in 90 days. Until then, Brian